Imagine two people. One has no debt. The other owes the bank 10 lakh rupees. Which one do you think the financial system prefers? Instinctively, we assume the first person is the ideal citizen, responsible, careful, financially stable. But in a strange twist of modern economics, the system actually runs better when the second person exists. Because in today's economy, debt isn't just tolerated, it's essential. And in many ways, the entire financial structure quietly depends on people borrowing more, not less. Right now, global debt sits at well over $300 trillion. That includes government debt, corporate debt, mortgages, student loans, credit cards, and personal loans. To put that into perspective, the entire global economy produces roughly $100 trillion of goods and services each year. In other words, the world owes roughly 3 years of total economic output. Debt isn't the exception, it's the foundation. And governments know this very well, because modern economies are built on a simple loop: borrow, spend, grow, borrow again. Let's walk through how this works. Imagine a government wants the economy to grow faster. Growth means more jobs, higher tax revenue, and political stability. But growth usually requires spending: infrastructure projects, housing, business investment, consumer purchases. And here's the problem: most of that spending doesn't happen with saved money. It happens with borrowed money. Think about the biggest purchases in modern life: houses, education, cars, business expansions. Almost none of these are paid fully in cash. They are financed: mortgages, student loans, corporate loans. Debt is what allows spending to happen today instead of decades later. Without debt, a person might save 25 years to buy a house. With a mortgage, they buy it today, which means construction starts today, workers get paid today, materials get purchased today. Debt compresses time. It pulls future spending into the present, and that's incredibly powerful for an economy. But here's where things become more interesting. Most modern money is actually created when debt is issued. When a commercial bank gives someone a loan, it doesn't usually hand over money that someone else deposited. Instead, the bank often creates new money digitally as part of the loan process. Your loan becomes new deposits in the economy, which means every new loan expands the money supply. No loan, no new money. This is one reason credit growth is so closely tied to economic growth. Now, imagine what happens if everyone suddenly becomes extremely responsible. No credit cards, no mortgages, no student loans, no business borrowing. At first, it sounds like a dream scenario, a debt-free society. But economically, it causes a problem. Spending collapses. Home purchases slow, business expansion delays, consumers reduce spending. Banks issue fewer loans, which means less money is created, and suddenly the entire system begins to shrink. Recessions often begin exactly this way. Credit slows down, spending follows, growth fades. This is why governments and central banks pay obsessive attention to credit markets. When lending slows, they intervene. Interest rates are cut, banks are encouraged to lend, stimulus programs appear. Sometimes governments even guarantee loans or inject liquidity into financial markets. The goal is simple: restart borrowing, because borrowing restarts spending, and spending restarts growth. There's also another layer to this story. Governments themselves are some of the largest borrowers in the world. The United States alone carries over $34 trillion in national debt. Many other countries operate with similar patterns. Why? Because borrowing allows governments to spend far more than current tax revenue would allow. That spending supports infrastructure, defense, welfare programs, and economic stimulus. In theory, economic growth generated by that spending helps repay the debt over time. But in reality, something interesting happens. Debt rarely shrinks, it rolls forward. Old debt gets refinanced with new debt, year after year, decade after decade. At this point, someone might ask a simple question. If debt keeps growing, why doesn't the system collapse? The answer lies partly in inflation and economic growth. If the economy grows faster than debt, the burden becomes manageable. If inflation reduces the real value of money, past debts become easier to repay. So governments walk a tightrope. Too much borrowing risks instability. Too little borrowing risks economic stagnation. Now, step back and look at the incentives surrounding the average citizen. Credit cards are easy to obtain. Mortgage rates are often subsidized or supported. Student loans are widely available. Advertisements constantly encourage financing. Buy now, pay later. In isolation, these look like consumer conveniences, but collectively they form a credit-based economy where consumption is often powered by debt. And there's a subtle shift that comes with this system. When people borrow, they become tied to the financial structure. Mortgages tie households to long-term employment. Student loans shape career choices. Business loans push companies towards constant growth. Debt creates obligations, and obligations create predictable economic behavior. People keep working, they keep earning, they keep paying. From a system perspective, stability increases. Of course, debt isn't inherently bad. In many cases, it allows investment, opportunity, and upward mobility. The problem appears when debt grows faster than the ability to service it. History is full of moments when credit expanded too far. Housing bubbles, banking crises, sovereign debt crises. Each time, the pattern looks similar. Borrowing accelerates, asset prices rise, confidence grows. Then something breaks, and the system suddenly remembers the risks it forgot during the boom. But even after crises, the system rarely abandons debt. Instead, it resets and begins expanding credit again, because modern economies have become deeply dependent on it. Not just governments, not just corporations, but ordinary people too. Which leads to an uncomfortable realization. If economic growth requires expanding credit, and expanding credit requires people willing to borrow, then the system doesn't simply allow debt. In many ways, it quietly encourages it. So the next time you hear about rising household debt, mortgage booms, or record levels of borrowing, it's worth asking a deeper question. Not just whether individuals should borrow, but why the entire economic system seems to function best when they do. Because if growth depends on ever-increasing debt, what happens the day people finally decide they